Okay, let's just dive right in. The next market crash is coming. It's not a matter of if, it's a matter of when. And for most people, that's going to be a financial disaster. They'll panic, they'll sell, and they will lose a ton of money. But here's the thing, for a small, prepared group, that exact same event will be one of the greatest wealth-building opportunities of their entire lives. So today, we're going to build the machine that puts you in that second group. And right here, this is where the two paths split. A market crash creates these two completely different realities, and it all comes down to one simple question. Did you have a plan? You see, for the unprepared, it's just pure chaos. Panic, emotional selling, wealth destroyed. But for the prepared, it's just business as usual. It's executing a rational plan, a system that actually creates wealth. The event is identical for everyone. The outcome? Well, that's a choice you're making right now. Now, what's really fascinating is how this all ties into compounding. We all know the magic of it, right? Your money makes money, and that money makes even more money. It's been called the eighth wonder of the world for a reason. But here's the secret nobody really talks about. Compounding is incredibly fragile. One big emotional mistake during a crash can literally wipe out years, maybe even decades of your patient progress. And this chart just brilliantly illustrates the brutal math behind that fragility. It's something called the asymmetry of losses. So if your portfolio drops by 40%, you don't just need a 40% gain to get back to even. Nope. Because you're starting from a lower number, you actually need a staggering 67% gain just to break even. This is exactly why panic selling is a trap you might never escape from. You're not just locking in a loss, you're setting an almost impossible goal for your own recovery. So what happens if you sell and try to time the market, try to jump back in later? Well, there was this incredible Fidelity study that looked at investing all the way from 1980 to 2022. If you stayed invested, your $10,000 turned into over $1 million. But what if you panicked and missed just the 5 best trading days in that entire 42-year period? Your final amount just plummets by over $400,000. Just 5 days. That right there is the price of fear. All right, so how do we beat that fear? The key is to completely reframe how we think about this. These events aren't shocking, once-in-a-lifetime catastrophes. They're a totally normal, predictable, and honestly, even a healthy part of the market cycle. You just have to expect the storm. I mean, just look at the data. A correction that's a drop of 10%, it happens on average every 1.2 years. A bear market, which is a 20% drop, comes around every 4 to 5 years. And a full-on collapse? Yeah, they're rarer, but they are a recurring feature of market history. So the crucial takeaway here is that this isn't a question of if it's going to happen. It's a question of when, and more importantly, whether you'll be ready for it. So how do you get ready? Not when the headlines are screaming and your portfolio is bleeding red ink, but right now, when things are calm. It really comes down to building a system, a kind of machine that works for you when your emotions are working against you. This machine, it's got 3 core components. First, you've got to protect your foundation. Second, you automate the engine. And third, you diversify the armor around your investments. Let's break down each one. Okay, action 1, protecting your foundation. This is absolutely non-negotiable. What this means is having 3 to 6 months of your living expenses sitting safe and accessible in a high-yield savings account. Why? Because when the economy turns down, life happens, right? A job loss, a medical bill. Without this fund, you are forced to sell your investments at the absolute worst possible time just to cover real-life costs. This fund isn't about getting rich, it's your insurance policy against being forced to get poor. Next up, you automate the engine using something called dollar cost averaging. This just means you invest a fixed amount of money at regular intervals, no matter what the market is doing. This table shows you exactly how powerful this is. So when the market is normal and the price is, say, $20, your $200 buys you 10 shares. But what happens when the market crashes and the price gets slashed in half to $10? Well, that same $200 now buys you double the shares, 20 of them. You automatically buy more when assets are on sale. By automating this, you take your emotions and your worst instincts completely out of the equation. It's beautiful. And finally, the armor. Look, proper diversification isn't about owning 10 different tech stocks. That's not it at all. It's about spreading your investments across different asset classes that behave differently. US stocks, international stocks, bonds, real estate. So when one sector gets absolutely obliterated, like tech did in 2000 or financials in 2008, your entire portfolio doesn't go down with it. This cushions the blow and keeps that compounding machine of yours intact. Okay,
So we've built the machine, we've got the foundation, we've got the engine, and we've got the armor. But there's one final opponent you have to conquer. And it's not the market, it's the ghost in the machine. It's you. This right here is what you're really up against. Loss aversion. All the research shows that the pain of losing $1,000 feels about twice as intense as the pleasure of gaining $1,000. And listen, this isn't some character flaw, it's a survival instinct that's hardwired into our biology. But in modern investing, that instinct is absolutely lethal. It's the little voice in your head that tells you to sell at the very bottom right before the big rebound. The legendary fund manager Peter Lynch saw this firsthand. His funds delivered an incredible 29% average annual return. That's just wild. Yet, he noticed that a lot of his own investors lost money. How is that even possible? Well, they let their emotions do the driving. They piled in after a great year when things were hot, and then they sold in a panic after a bad one. They literally had a winning lottery ticket, but decided to cash it out at exactly the wrong time. So, the only way to defeat that biological impulse is with cold, hard data. You need proof. You need to know that staying the course isn't just some hopeful mantra, it's the only winning strategy. And get this fact just reveals a cruel irony of the market. Seven of the 10 best single days in the entire history of the S&P 500 happened during the chaos of the 2008 financial crisis. Think about that. If you sold out of fear, you not only locked in your losses, you almost certainly missed the explosive recovery days that came right after. And we just see this pattern repeat itself over and over. In 2008, the market fell a gut-wrenching 57%. In 2020, it fell 34% in just 5 weeks. Both of those times felt like the end of the world. And yet, both were followed by powerful bull markets that massively rewarded those who treated the crash not as a catastrophe, but as a massive discount event, like the sale of a lifetime. So let's bring it all together. The blueprint is actually pretty simple. First, you have to understand that crashes are normal. Then, protect yourself with that emergency fund so you're never a forced seller. Automate your buying to take emotion completely out of it. Diversify so no single event can wipe you out. And finally, write down your plan. Seriously, write it down, because that piece of paper is what you'll turn to when your instincts are screaming at you to do the absolute wrong thing. Look, the people who get rich in market crashes aren't smarter than you, and they aren't luckier. They are simply prepared. We've gone through the entire blueprint. The data is crystal clear, the strategy is proven, so the only question left is the one right there on the screen. The next crash is coming. Will you have a plan, or will you panic?